think the magnitude of the decline in iPhones was bigger than anyone anticipated. There were lots of warning signs from the supply chain that iPhones would be weak. But the initial reaction is that was worse than we thought. We think iPhone revenues will be down about 14% year over year in the quarter. Units will probably be down more than that. That's pretty significant. I think stepping back, this is really a manifestation of, I think, the core challenge that Apple faces today and longer term, which is they're playing in a mature market, and replacement cycles for their device appear to be elongating. So if there's no market growth and people are holding on to their devices for longer, that could translate or will translate into lower unit growth going forward, and that's what we're seeing.
Yeah. What should investors do today, Tony?
Look, I don't think there's any need to rush into buying Apple today, and that's based on two thoughts. The first is that if you look at the valuation on a relative basis, and it's really important to look relative to the market because stocks are really cheap. Earnings went up 20% last year, and the markets are down 10%. And so everything's gotten a lot cheaper. But on a relative basis, it's trading at about average levels versus the last 5 years on an earnings basis, and above average levels relative to the market on a cash flow basis. So Apple's not that inexpensive, point one. Point two is we don't know whether numbers could still come down. Things could get worse in China. Apple may have built inventory because if demand slowed very quickly, there could be inventory in the channel. So given that valuation isn't compelling, given that numbers might still need to come down, and given that we don't think next year's iPhone cycle is going to be particularly compelling, I'm not so sure you need to run out and buy the stock.